when that's disconnected and you have a subset of people that's maybe as large as 50% of the population that feels like no matter what they do, no matter how hard they work, they cannot get to the neighborhood that they want to raise their kids in or whatever else is their financial goals, that's really concerning.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
What up, everybody? Welcome back to Skippy and Doogles. We're going to start today's episode off with a special announcement from Skippy. Then we're going to go into the dot-com era on steroids. This is a report put out by GQG Partners. It compares the dot-com era to right now, which we've done a few times as a deep dive. I'm going to wrap things up with some additional listener mail. Skippy, you know what? I know you're probably tears going to come out your eyes. So I won't even let you make the announcement. This is a huge professional shift. Skippy has decided to work for Robinhood and run their new private venture fund. Just to talk to us about it. Why do you want to do this?
Well, I listened to Vlad, the CEO, on the Collison podcast, A Cheeky Pint. Have you ever listened to this?
No, I like the title though.
Collisons are such classic Irish folks that they recreated a pub and they invite people in and drink Guinness over a pint, and it's their podcast. So I like that part of it.
That's pretty cool. Yeah.
And he just spoke to me, man. It just sounded like, you know what? Not only are they going to tokenize every asset with crypto, and like as if we can't freely trade stocks and ETFs and mutual funds today, but they're also going to take ownership of things they don't actually own, put a token on it, and then sell it to people, which is pretty clever. I mean, I think when we go to like Ponzi scheme land, Madoff land, it always starts with selling something you don't own. So I think that's a good foundation to start from.
Phenomenal. I love that he spoke to your soul. By the way, this is a huge joke if you all did not pick up on that. Skippy is not joining Robinhood. But what Robinhood is doing, Robinhood, the brokerage, I think everyone's probably familiar. Robinhood is starting a closed-end fund, which, and this is their quote, that will focus on a concentrated portfolio of private companies at the frontiers of their respective industries. They've democratized access to stocks. Now they are saying we're going to democratize access to private companies. This is a terrible idea. Unequivocal.
Is it ever? But so, okay, another sign, we're just going to continue last week's theme since everyone else in the world is calling this a bubble now. When you're living through it, one sign of a bubble, I think, has to be that everyone is launching a fund. Everyone's trying to explain, well, this is a GP and this is an LP, and we have this unique opportunity that no one else has. And I see that in my email box 3 times a week. Someone who has no business launching a fund is launching a fund. That's just the world today. Let's try and tie this all together for the novice who might not know. So companies, and Stripe is the perfect example. We just talked about the Collison brothers. Companies are not going public like they used to. And there's a lot of reasons for that. There's a lot of speculation for that. One of the reasons is if you stay private, you have more control. And what's happened in the last 10 years is people would give you money as a private company like they never would before. So you actually don't have to go to the public markets because there's so much money in Silicon Valley and other places, high net worth individuals. And I'm not talking like have a couple $1 million. I'm talking about have like hundreds of billions of bucks that are happy to own shares in Stripe.
Yep.
And so that's a problem because it does not give the standard pipeline of new exciting businesses entering the S&P 500 or the NASDAQ, right? But then we're creating all these other problems on top of that problem rather than fixing the actual problem. So now, there's so many business models about we help you invest in private companies without the disclosures that would come with a public company, meaning quarterly reporting, annual reports, shareholder meetings, everything else. Go ahead.
Look, I feel like a lot of what I hear about things like what you're describing right now are often described as pure burdens. Like they're like, oh, as you're stating, right? Not going public, because if you go to public, then you have to do all these things. And I'm not saying that they're easy. I'm not saying they're not expensive. I'm not saying that they aren't burdensome, but they are viewed as pure burdens, and they are actually helpful for organizations. It's helpful from a discipline perspective. Now, not all of it. I'm not saying every element of it is purely helpful. I'm not trying to be a purist there. I'm just saying that in general, the need to have to describe your business, describe the risk, disclose those things to shareholders, for you to have accountability for your spend, for you to have accountability for cash flow, things like that are good forcing mechanisms in general. Again, not every element is fantastic, but in general,
99% of the time. I mean, so if I ran a $100 billion company and say I founded it, I would want to be private, but I also probably shouldn't be the CEO of a $100 billion company. Like, because my interest at that point, I'm sick of all the minutia and I want to actually go do the fun stuff, right? Mm-hmm. I think so SpaceX is another great example here of a huge company, somewhere in the range of $300 billion that's private. OpenAI may be worth hundreds of billions. We said the latest estimates last week were $300 billion private. The list goes on. And so take a deep breath, Doogles. I think Robinhood does a lot of things really well. I think some of the user interface on their app is like light years ahead. It's still light years ahead of your average brokerage out there, which is crazy to me. I have a whole list of feature requests that I know they could implement tomorrow, but the things that they would do is make people trade less frequently, and that's not their business model. Their business model is for people to trade more frequently. I also respect that they just go get stuff done, right? So there is 5% of the investing population that thinks this is a problem and thinks they have to get their hands on some private companies. They're building a product. They're going to make tons of money off of it. In a way, good for them. But what you said from the investor's perspective of this being a terrible idea, I will also 100% endorse. This is a terrible idea.
And I'm in general, like in theory, maybe I should say, in theory, I'm all for democratizing these things. In practice, it's so dangerous. So dangerous.
Talk about that a little more, because one, in a fund like this, you have to be an accredited investor. So
you don't. No, you don't.
What?
You don't. So what Robinhood, I'll give a little more detail. And they have not put out a lot of detail, but I'll give everything that I've read that they're putting out.
Oh, that's even worse. I just read the fine print. Oh, my goodness.
So Robinhood is they're going to have an initial public offering to trade Robinhood Ventures. So anyone can go and within their brokerage, and this is the plan. They haven't done it yet, but this is the plan. Anyone can go within their brokerage and buy into this. Behind the scenes, Robinhood will then be purchased, or whoever is managing this for Robinhood Ventures Fund, will be purchasing private companies. They are going to be illiquid. There's not going to be, because it's closed end, I mentioned that, you can't redeem the shares. You can trade them on the stock exchange. So I could trade with Skippy if we both own, but Robinhood will not be putting out more or taking back shares. So you just have illiquid shares that are out there. Who knows what they're going to be investing in? You don't have to be an accredited investor. Not that even that is necessarily a meaningful thing, but you don't have to be. This is Robinhood. I'm going to go back to something you said, because I do agree with. I think Robinhood's done a lot of things well, especially from my perspective. If you are again, people will probably disagree with this. I think that if you have some level of sophistication and you've been in the game for a while when it comes to investing, I think Robinhood can be great. It makes it so much easier to do stuff that other folks don't. I've told the story in this podcast that when my wife went to get her Schwab account authorized to trade options, she just had a fully misogynistic conversation where the guy was so rude and mean and belittling to her. It took a lot of paperwork. I had to become a power of attorney in her account so that he would allow a man – he did not say these words, but this is basically what it was – allow a man to make sure that she was doing okay trading options. It was such a thing. Robinhood is like, click this little button. You can trade options. Right? They make everything so easy.
Pros and cons. People, you should not trade options. It's a terrible idea.
No, you shouldn't. But that's the thing. They make it so easy that, like, these things that if you know what you're doing, which I'm kind of putting in quotes because some of this stuff is just dangerous even then, they make it easy to do this stuff. And I think that in theory, that's great. But 99% of people don't. And so therefore, in practice, it becomes pretty dangerous. People will disagree with that. but my take.
No, there's one other thing. I mentioned this a couple weeks back. It's basically a closed-end fund, although it's not called it. It's a company called Arrived.com that really got popular during the peak housing bubble, like 2021, the Airbnb. Everyone's buying an Airbnb, right? They allowed people to buy fractional shares. It's a really cool concept of rental properties, including short-term rental properties, right? And so you buy a tenth of a house or whatever, and then you collect rent. They manage the property. Really cool idea. Backed by a bunch of people that know what they're doing. I've always been intrigued by this company. I have some investments there, small stuff, and I feel like it's what Robinhood will be in 5 years. This is the reason I'm trying to illustrate the point. Now they allow some trading behind the scenes between different shareholders, and I told you, those prices, they're frequently 30% less than the purchase price. So that tells you so much. It tells you about the real estate markets in Florida and Arizona and these other hot Airbnb places. It tells you that people are cash strapped right now. But it also tells you that in a closed-end fund with illiquid assets, which is exactly what this would be, it's a different type of asset, there's just naturally going to be this discount. Well, no, in some cases there will be a premium. There's a thing in most investing called a NAV, which is a net asset value of the actual underlying investments, right? In closed-end funds, you're more likely to get far disconnected from the NAV on the negative side or the positive side. All I'm trying to say with this real live example is I hope people understand. There's no chance people that buy this are going to understand what's happening here. They're going to be like, I want to own SpaceX. I read a headline that implies this might allow me to own SpaceX. and think about the logistics of that, Doogles. So Robinhood's going to find out that there's interest from these retail investors to go buy SpaceX. They're going to have to acquire those shares. They're going to acquire those shares at whatever price someone is willing to sell them those shares. Which will be inflated by 50% or more. I mean, that's what I would do if I owned the private ownership. Go ahead.
And in this is really important. I can imagine that the things that we're saying right now could possibly come off as condescending, in that people are not smart enough to understand how these work. And I can see where people would be like, no, I am. And that is not what we're saying. Correct me if you believe differently, but I don't think we're not talking about people's intelligence.
No, I appreciate the clarity there. This is not condescending at all. I'm trying to explain the logistics, the limits here. That public markets that freely trade with tens of millions of dollars available each day to match buyers and sellers to find an equilibrium price point is a great thing that doesn't exist in any of these closed-end or private funds. And there's tons of problems with that.
And it comes down to incentives, which you always bring up, which I think is wonderful. It comes down to incentives. The person selling the SpaceX shares, just in this one example, we're just using SpaceX because the person selling those shares, they are incentivized to get the most money from the person that is buying those shares from them. They're not incentivized to think about the LPs or the investors of Robinhood Ventures. And so therefore you're putting your money into something that you can't possibly understand how it's going to work on the back end or be privy to that. And because it's just not possible, not because of intelligence. It's just like, you're not running the fund. And the incentives of the folks that are both running the fund and selling those shares are not necessarily aligned to you. It may seem like it.
No, they're not at all. And this is my other point, which is you get disconnected from fundamentals. Like the retail investor in this crazy example that decides they must own SpaceX or must own Stripe because they think the companies are cool, don't have great information about their current financial situation, how their revenues are growing or shrinking. I mean, they're both growing at this point, but how, like, what their profitability looks like, what their growth plans are, what the clear risk to the business. The leadership team at SpaceX knows all this information about what the next 12 to 24 to 36 months looks like that is not going to be disclosed to the investor. It's a dangerous, dangerous game. Gosh, you got me fired up. I mean, I thought we were just making jokes to start the show. This is a bad idea.
Fry it up. Let's transition. Reach into the fishbowl. Talk about this GQP Partners piece called the .com on steroids. It's a long one. You'll get it on the Substack, skippydoogles.substack.com if you want to subscribe to that. So we're going to go over some of the key elements of it, but you'll have to read the whole thing yourself if you want all the detail. Just if I want to summarize this whole thing, it's this. There are people that, maybe not in this exact quote, but there are people today that are saying what's happening today with AI, if you compared it back to the dot-com era, we're in 1995, baby. We are 1995. We still got years ahead, et cetera, et cetera. This piece is saying, no, we in 1999, player. Like, we are at the tail end of this, not at the start of this.
Is that the best argument right now? Is that it's definitely a bubble, but it's early. It's early. We can.
And this is one thing that's interesting, is because as we go through what this piece lays out, is if you look at the data, I hadn't looked at this, so I'm trusting what they report on. If you look at the data in 1995 was not a bubble. Like, it was very clearly not from a valuation perspective. And so if you want to compare this to 1995, the numbers don't really show that. You have to believe the narrative. You have to believe this time is different. You have to believe something along those lines. And they're saying that, as we point out here on the show, the capital intensity that's happening right now is more similar to the capital intensity, but a little beyond, of what was happening with telco in the late 90s. Mm-hmm. They talk about the energy boom and what Exxon was putting into CapEx in 2014 as an example of the end of that energy boom as well. Valuations are rich, and they also say they're deteriorating fundamentals. These are the things that they point out. I'm gonna go through some of that in a little more detail. Before I do, something else, another stat that I found to be interesting is they say that of the approximately 1,700 active large cap U.S. portfolio managers today, 4% were also investing during the dot-com era. This is similar to something that we talked about when we were discussing the Great Financial Crisis before.
Yeah, that's quite a stat.
Yeah, it is. And I am not a large cap U.S. portfolio manager, but even when I think about myself, I didn't invest during this period. I started investing right after this period. And so that I don't know what it was like there. And what they're saying is reading about something is not the same as experiencing it, which is quite true. And so it's good to keep that in mind.
That's so funny. I was investing during that crash, and it was not fun. But goodness, some deals I picked up at the trough just because I was I don't know what else to do. I used to like this thing when it cost, 3 times more. Those were some great deals. I would love for that to happen again.
Oh my goodness. Last thing before we get into the nitty grit, as they quote Sam Altman, and this is the quote: "When bubbles happen, smart people get overexcited about a kernel of truth. Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes." The part I really like about this is the kernel of truth component. I think that's really important, is that often I think when people hear something about being in a bubble, the assumption is that what you're saying is what's happening isn't real. Like, back then, I don't believe in the internet, so we're in a bubble. Yeah. I don't believe in AI, so we're in a bubble. And that's not it. There's a kernel of truth, and people are just overly excited about it. But there is a kernel of truth.
I mean, I feel like a broken record. We both believe in AI, and we both think it's awesome. We both think the economics of it are ludicrous right now. Like, the amount of money OpenAI has to lose. We detailed this. At some point, their future investors or their future debt providers, it seems rational to me to say, hold on, take a pause here. Like, we're not writing you $100 billion check, or the Oracle deal is $60 billion a year at least. Like, where does that money come from? Because the economics don't work right now. Because they are giving me, every time I do my search or my chat, they're giving me like $100 worth of value, and I'm either paying them $0 or, I mean, at most $200 a month, right?
Yep.
So the economics just don't work. It's awesome.
Yeah.
It's really, really cool stuff.
Touching on what you were mentioning before around the big checks that are going into the private markets. I just Googled this, so I'm going to take what I Googled as truth here for a second. Do you know how much money Apple raised in venture capital before they went public?
I heard the other day that their first round, I don't know, but I heard the other day that their first round, I think, was $1 million check at a $10 million valuation? It's something like, I don't know. Tell me.
What I'm seeing here, and again, I just Googled it. So first is the first thing that popped up. What I'm seeing here is around $700,000 total.
Goodness.
And Microsoft raised like $1 million before they went public.
That might be what I'm thinking of. I might be thinking of Microsoft. But so Microsoft was like profitable, I'm exaggerating, like the third month, right? They were the ones that were like, oh my goodness, software. Because we just send these little discs to people and they pay us money. And once we write the code, our fixed costs are basically the cost of shipping, and to print a little CD is nothing.
Yep. And they were around a 10-year-old company at the time. Apple was a little younger when they went public, but they didn't raise a lot of money. It's in so much contrast to not every company today, but when we talk about someone raising $100 billion, $10 billion, like there's just so much money. Even if you take that amount of money and adjust it for inflation, I don't actually know what the adjustment is, but let's call it's a 30x difference. It does not compare to the amount of money that these organizations have to raise right now.
I have good stats there. Let me see if I can find them. But there's an incredible breakdown of exactly that, like how much money these really impressive companies raised to get off the ground versus what's happening today. And even a company like Uber, from memory, I think raised $27 billion, which just completely dwarfs anything else of the recent past. But then OpenAI, they're on a trajectory. I think their current projections say they needed to raise at least $160 billion. Like, it's just completely different orders of magnitude. And that's basically my point. Like, who's going to write them that check?
Not us. Maybe you at Robinhood Ventures. All right. So first in this piece, they start off with the similarities. So they say, what are the similarities to the dot-com era? They name two. They said one is U.S. exceptionalism, and the second is revolutionary technology. What they mean by those, and I don't remember which episode, but we talked about the U.S. exceptionalism piece a few episodes ago. And there, what they're saying is you have this trade where all the assets that are worthwhile, I'm putting that in quotes, but worthwhile as a perspective at the time, are going to the U.S. If you go into the late 90s, you've got Russia default, the Thai bot collapsed, if I remember correctly. There was so much going on over in like emerging markets and overseas that the U.S. was the place to go. That's where you're putting your money. That's where all the hotness is. That's U.S. exceptionalism.
Let me jump back in. I'm sorry to interrupt, but I found that I was looking for. So here's the total external dollars raised from a few highlighted companies. Google, about $2 billion total. Facebook, about $2 billion total. Netflix, $3 billion. NVIDIA, $4 billion. Amazon, when it's all said and done, $8 billion. WeWork, we know how that ended, raised $14 billion. Tesla raised 20 and seems to have rode through that storm. Uber, $25 billion. OpenAI's current estimate for the amount of funds needed to raise by the end of 2029 is $177 billion. So sorry to interrupt, but wanted to put a bow on that.
That's a lot of $1 billion.
It's different. Back to your talking points about how this is not a bubble. No, I'm joking.
Just the belief that you have to have of what they're going to do is so large. It doesn't mean it's not going to happen. It's just so large. If you are investing in a private organization over the course of a decade, you want to get 10x at a minimum your money back. And so we're saying at a minimum, $2 trillion. That can now happen, right? There are multiple companies that are over $1 trillion, $2 trillion.
That are like the 6 best companies in the history of the world. I mean, come on.
Yeah, exactly. So that is a thing that could occur. But anyway, okay. All right, back to this.
No, wait,
right.
It should be, to your point, it should be more like 20x, 30x.
Yes, it should be.
100x. Like,
as I'm saying, like the minimum.
X is like kind of what you need to get your money back.
Yeah. A 10x is when you go like, okay, the least common denominator happened. Like that's the 10x. Yeah, you're really talking a lot more. The second similarity that I mentioned was revolutionary technology. I think that one, we don't have to explain that one. It was the internet back then. Now it's AI. But then what they state is they say from a metric standpoint, a metric and narrative standpoint, here are other similarities that fall under there. Valuations are frothy. NVIDIA, I like this comparison. I hadn't thought about this before. NVIDIA is today's Cisco. So Cisco back in the 90s was viewed as the company where if you imagine that the traffic to the internet is increasing just doubling and doubling. I'm talking capital of Ireland, baby. If that is happening all the time, then Cisco, who has all the router switches, that controls the internet effectively, everything has to come through it. Just like today, AI, doubling. NVIDIA has all the chips.
I just got your really lame Ireland joke, by the way.
It's sitting right behind you. There's a picture Dublin right behind you. And the comparison they make, I only wrote down one of the pieces here, so maybe you can find the other one. But they said NVIDIA is 15% of US, like NVIDIA's market cap is 15% of GDP, which that's right. Like, I can't remember what Cisco was. I think it was in the single digit percentages or something, but regardless, frothy.
Yeah, and I have to do the caveat there that that's a really bizarre comparison because market cap is not equal to GDP in any way. Market cap is like the rough estimated value of GDPs that there were goods bought and sold, like whatever, it's big. But
well, but Warren Buffett likes to compare total market cap to GDP, so
I guess
I know,
that
no, I know
where they're going with it. Yeah,
I think that's where they're going. All right, then they talk about Microsoft in 1999 was 60x PE ratio with 35% growth at the same time. So they hit these growth figures a lot because they say if you look at both the multiple and the speed at which they're growing, these companies, they're much larger now, but they're growing slower today than those companies were growing then, but have similar-ish, in some cases, and like this one is lower, valuation ratios. Oh, I like this one. They had this chart of, they took the names in the S&P 500 that were trading above 10x price to sales ratio. And this is a figure that you like to quote Scott McNeely about back then, of just how 10x is large.
Scott so much.
10x is just, that's a really big number when it comes to price to sales. So they were saying back in 1999, at the end of 1999, 25% was the weight of those names that were trading above 10x. Whereas today, if you look at all the companies that are trading above 10x, they represent 35% of total market cap. So what that means is that there are a higher concentration of companies today that are overly valued when it comes to price to sales. I like
this
that.
This is my favorite chart, and there's a table below it in the whole piece. I mean, they list companies that are trading at more than 15 times sales. And again, I'll try and do the abbreviated version of the quote. That just means if things sit where they sit today, that means they'd have to, at least for the next 15 years, take 100% of their sales, assume that there's no cost in the business, which is idiotic, and send that back to shareholders just for the shareholders to break even. Not happening. I'm sure there's an exception, but basically it's impossible to make money when you're buying companies that are that expensive. Like Palantir is 89 times sales. Okay, so yes, there's some growth involved, but the growth better be like doubling for the next 20 years. Slightly hyperbolic, but not crazy.
Directionally,
yeah.
Right. All right, I'm gonna speed this up a little bit. Then there are some myths that they debunk. The first is, or they try to debunk. Tech companies today are higher quality businesses compared to 2000. They're saying a lot of people say that. They go through some reasons as to why they believe that's not the case. The second is tech companies today are cheaper compared to 2000. We just touched on a little bit of that. But one of the things they bring up from a CapEx perspective is they look at CapEx as a percentage of EBITDA. And they're saying it's now 50 to 70%, similar to, as we mentioned before, the 2000 telecom and the 2014 energy quote-unquote bubbles. Then the last myth is the broader U.S. market. So not just tech, but the broader U.S. market today is cheaper compared to 2000. They look at the PE ratio of the S&P 500, which is pretty much right around where it was in 2000s. But they say that companies were growing faster back then. And so they're like, at least there was more belief potentially then in their eyes. So we'll put this out. You can read more about it, but I wanted to give those high-level points.
Let's just talk about Sam Altman for a second, because you might hear this conversation and be like, well, okay, it seems like raising $177 billion might not be the best business plan. But Sam's a smart guy. Like, he'll just change his mind, and then Skippy and Doogles are going to look like idiots, and OpenAI is going to be the world's best company. Let's just talk about if he knows in the back of his head that that's true. Just bear with me for a second. I think he probably knows in the back of his head that that is nonsensical and is not a a path to success for him. But what is his alternative? He doesn't have he can't stop raising money right now and just run a profitable business. He loses $8 to $10 billion a year, and that's planned to double. He's so far down this road, and in a way, Zuckerberg and everyone else is so far down this road. Now, Meta does not seem to care. Meta just seems to think, and I think Microsoft and Google might be this way too. They seem to think we can outspend everyone in the world, and when we do that and crush the competition, we come out on the other side so much stronger. So we're going to laugh at Sam when he's bankrupt, because he will be. My point is, I totally understand why the nonsensical CapEx may continue for another 3 to 5 years. The incentives here are weird.
And on the Google and Meta piece, something we skipped over in the report, but y'all can read about it, is it talks about how the CapEx is being predominantly funded by digital advertising dollars. And so in that world, I'm going to go to an extreme here. Let's imagine the world in which the economy starts to recess a little bit. People pull back their Facebook, Instagram advertising. So therefore, revenue growth at a minimum may just start to decelerate or be lower in the future for Meta. And let's imagine a world where there is $160 billion that comes into OpenAI, and they continue improving their product, and it chips away aggressively at Google's ability to make money from its AdWords product. Let's just say that these things happen, and you're running CapEx that's 50 to 70% of your income, just to put it simply, of your income at that point, and revenue starts to decelerate that much. That's a hard situation to be in. Does that occur? We don't know. But when you're spending that much, you start to lose optionality. And that's what I would say with Sam Altman. Your description, I think, is exactly right. The way that the organization has been run, I'm not saying it's bad. I'm just saying the way it has been run, you don't have as much optionality. You got to raise.
Well, and what you just described has been the bear case for Google, which was the predominant market thinking 6 months ago. Now it's 180 degrees from that. Now everyone thinks Google's going to own the world. The stock's up like almost double during that time frame.
Yep.
But if you are saying OpenAI competes with Google and Microsoft, Google and Microsoft have revenue engines that aren't related to AI, like with cloud
AI
and search and
it.
1,000 other things.
AI fuels part of it, but it's not directly related to AI.
It was in place long before AI was even in the nomenclature.
Yep.
And that's a huge advantage in my eyes.
Yeah, it's true. Very true. They have both those companies have multiple large businesses.
Yes.
All right. Anything else here before we transition to listener mail?
No, let's do it.
All right. Hit that jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles Show.
Thank you, Chris, for sending this in. Chris sent us his fishbowl, which that means you've been listening for a long time when we talk about reaching the fishbowl, and you refer to your listener mail as a fishbowl. I appreciate that. He had a couple different pieces in here. The first is he highlights this Atlantic article. It's called The One Parenting Decision That Really Matters. Spoiler alert, just to jump to the end, that's where you live. On episode 236 here, which is called Passive Income Lies, Brewdog Drama, and Zip Code Economics, we discuss an element of what he mentions or what's mentioned in this Atlantic article, which is that Opportunity Insights research that looks at the zip code where you grow up and the impact it ends up having on your economic status later on. Credit score specifically was one of the things that we highlighted there. That's a lot of what this article ends up coming down to. It names a few things. Like it talks about how if you are a parent and you look at all the small decisions that you're trying to make throughout life and saying like this decision to study more at this point, the decision of where I send you to private school, all these other things. There's so many things. What I feed my child. There's so many things that come in that parents got to take care of. He said in the end, when you strip everything away, where you live is the biggest decision that a parent can make. And the one that studies are showing is the one that has the most influence.
That always makes me incredibly sad. Because I like to think there's more free will than that. But I understand the science. The only counter argument that I would present is this is a science backwards looking 30 years ish.
Yep.
And that doesn't necessarily mean that it will hold true 30 years from now. But as you just did a great job detailing, we've talked about this a bunch, and it's incredibly fascinating research to read.
And the part that makes this highly logical to me is as our oldest are around the same age. And as I get to this age, I realize it's so little time that I spend with him now. Like when my son was 6 months old, nearly all of his life was influenced by his parents. Like basically everything.
Yeah.
That was true at 1, 2. Now we spend like 40 minutes a day together. And the rest is school, which he goes to the neighborhood school. That is influenced by where we live. It's the friends that are in where we live. It's the merchants when he goes into the store. That's where we live. And so
the peer group matters a lot. I agree with what you're saying. I also have a personal belief that this is maybe the wrong term, but kids are almost fully baked at like somewhere between 5th to 8th grade. There are some of my son's friends that I already know are headed to Stanford to be a doctor. Like, it's baked. I already know it. And even going back to my peer group growing up, the right people in the right advanced classes, like now are lead doctors for professional sports teams, etc. Like, they're just some people that you can see very early on, and those are the peers that influence their other peers, usually in a positive way.
The second thing that Chris brings up here is about Gary Stevenson. How familiar are you with Gary Stevenson, Skippy?
I'm not. This is the first time I'd heard of him.
Gary Stevenson gets very angry. That is like, if I had to give one emotion, that is the one I've seen the most in Gary Stevenson. I've watched a bunch of his videos. I've read his book. He is very angry. He talks about income inequality a lot. And his general premise is that the tax system, he's British, by the way, lives in the UK. His general premise is that the tax system is so overly advantaged toward the wealthy, and we need to flip that around, or else inequality will just continue to take off. Mm-hmm. His general backstory, and this is what he wrote his book about. His book's called The Trading Game, if anyone's interested. He was the most profitable trader at Citi about 10 years ago, basically betting against the world economy. It was effectively how, and he was making all this money, and it drove him to be very depressed for a bit, because he was just like, I made this bet against the world. That's how I made all my money. Now he gets angry making income inequality videos. I think it's worth like watching some of his stuff. It's interesting. I find it to be. The point that the reason Chris brings this up and he connects the two is that Gary Stevenson, in one specific video, he talks about compounding and how people say that compounding is the way that if you don't have a lot of money, you can get a lot of money. And the math works that way. Compounding is very, very powerful. But in practice, with what Gary said compounding really just benefits the rich, because the rich are continuing to own the assets. And we're at a point where it's not the Wild West anymore, and there's so much more pie to grab. It's more that the pie is becoming more scarce and limited. And so it's buying resources that already exist. And the rich are the ones that are able to do that to take care of the compounding. And if you combine the where you grow up, where you live, with scarce resources and the wealth you're compounding, the thing that Chris is kind of raising is like, what do y'all think about this? Because what these two things say is that where you live matters, and the people that can live in these places are the wealthier people. And so is it just that inequality is continuing to compound? It's a huge question. We can't answer fully on our podcast, but I like that he put these two things together, and it's an interesting conversation that could stem from it.
Yeah, I love the listener mail. So take a stab at it, Doogles. Give me a few thoughts on that.
I just been talking for the last 3 minutes. You can't give me even like a sentence? Okay. All right. This is actually really hard to do tiptoe in the tulips in a nuanced way through this, because there's so much nuance, but I'm going to give it a try. I do believe that generally speaking, the premise that Gary Stevenson makes around and I'm going to change some of his words here. It's much easier that if you already have something to get more of it. I think it's much easier for people that have money to compound in this case. Much easier. So that premise, I think, is true. I also say that where you live also matters a lot. But where I Not that Gary Stevenson says this explicitly, I don't think that I've seen, but where I start to disagree in the nuance is that it doesn't mean that you can't do it if you're not. And sometimes it feels, his words to me can make folks feel powerless in the day-to-day, but powerful in the rhetoric. What I mean there is that it can make you be like, yes, we are against the system together. We're going to rise up together. And like that can make you feel powerful. But in your day-to-day, it can make it feel like, oh, okay, well, if I don't get rich, then there's nothing I can do. It takes away from no, put away $20 a month or whatever possibly you can put together a month, and you'll still be better off than you would be otherwise. And I feel like that message gets lost.
Yeah. Morgan Housel tells a story of his brother-in-law who is a social worker, thought he was, being the world's hero, and was giving this family a basic financial lesson. Again, best intention. And he's like, so I think what you guys need to do is like start to put a little money aside and we can grow that and then you can plan for unexpected expenses. And this family is just laughing at him, like literally laughing in his face. Like, oh, you're one of those people. Like you think that we can worry about what happens in a week or two? Like, no, the money we live, our money situation is hour by hour. Like we think about how to get money for the next meal. That's it.
Yep.
That may be an extreme example, but the broader point here is like there is some basic level of wealth that's just enough to live, and that's it. And in some cases, less than enough to live.
Yep.
All the speaking points about investing in compound interest and stuff just don't matter. They do not matter if you're food insecure. And so there's the thing that bothers me most about this concept is a psychological belief. We've talked about this a fair amount, that a lot of people think the American dream doesn't exist anymore because they don't feel like hard work is rewarded with extra income. And that's all I would say, is that tie is incredibly important to our political stability and to our ability to have optimism for the future. I don't know the fix, but that has to be fixed because that is truly what makes the country an exceptional country. When that's disconnected and you have a subset of people that's maybe as large as 50% of the population that feels like no matter what they do, no matter how hard they work, they cannot get, to the neighborhood that they want to raise their kids in or whatever else is their clear financial goals. That's really concerning to me.
I think you just said that beautifully. And that's where maybe nuance isn't even the right word. But I say nuanced because the thing I was saying before, I believe, and also to say something that you just said a little bit differently, but I think you said it beautifully, is it's also binary. That's when you talk about the minimum threshold. That's what I mean by binary. I believe what I stated before, but that's really only true. That $20 a month is really only true if you can do that. And you have to have whatever the minimum is to be able to put whatever the amount of money is aside to be able to pay for your food and all that stuff. And there are two things I'll mention here. One is Gary Stevenson, and one is a story we talked about before, where there was someone in my family who I was, through circumstance, I ended up paying their rent and whatnot for a while. And they're like, you sure you don't want us to pay you? And I said, no, instead, what you would give to me, invest it. And I was like, open up this account, open up that account, invest it. And then when I got into conversation with them, I realized they were $100,000 in debt at 11% interest. And I was like, never mind, everything I just stated
is not true.
Just start paying that thing off. Like, you gotta, and so it's different. Like and it's not always debt with folks. That could be your living expenses, like whatever it might be. One thing that Gary Stevenson does in the video about compounding, he draws this picture and he says that this is how compounding works. And I think he used the example of somebody in his family. It's like you save up that money and it grows, you save it up and it grows, then you have a kid and your baseline then decreases. You're saving up money, it grows, you're saving up money, it grows, then you buy a house and your baseline decreases. And then you save a little bit, it grows, you retire, then you start spending it, and you end up below the zero line. Because at some point you may have been above it, but when life, I'll call it, starts to happen to you in a quote-unquote even like ordinary way, it's hard for that person to then really save up to get above that threshold point when they do the standard things. Have child, buy a house, get car, whatever those things are. When they do the standard things, then you don't, and that's just life.
This is the This is the part that many of our financial experts miss, I think. They'll give you the basic advice like save 10 to 15% of your wealth for retirement, do this, put some money aside, have 3 to 6 months of expenses. They often miss that your savings. So people would come away thinking their savings rate need to be like 15 to 20%. If you actually want to get ahead, it's probably like 20 to 30% or more, because you need the savings that goes to when your house plumbing explodes, the saving that goes to when your car explodes, everything else. And then you need the savings that is actually for future needs that's not your retirement that you can invest and grow. Like, I think we do such a poor job of teaching what it actually means, and the money that flows into your personal account when you get paid, how little of that you actually get to spend on fun stuff. It's not much, unless you're in a completely different world where you're making tens of millions, right?
Exactly. This is good listener mail.
It is. My favorite part of Chris's email, and I love the whole thing, but at the bottom he says, if I had more time, I would have written a shorter email. Love it. Thank you, Chris. That's it for this week. You know the usual stuff, content we talked about. If you want to see all the charts, skippydoogles.com, which can take you to the Substack, which you can get an email subscription and get this in your mailbox each Monday. Premium subscriptions to support the show are at skippydoogles.supercast.com. And we'll see you next week.
Bye, everybody.